Tesla are leading the next round of tech earnings. Those results coming after the closing bell as investors' concerns keep piling up. Ed has more. Hey, Ed.
Yeah, good morning again, Jonathan. Well, we see the stock lower 1.9%. Both JP Morgan and Morgan Stanley cut their price targets on the stock ahead of earnings, basically saying that they're looking at those price cuts, particularly in China, and what that will do, not necessarily as a lever and driver of demand, but what it means for profit going forward. Analysts expect adjusted earnings of $1.12 per share on $24 billion of revenue. That would represent sequential and year-on-year growth, but they go straight to gross margin, right? Tesla is kind of the industry leader when it comes to gross margin, which analysts expect to come in at 25%. What does the impact of those price cuts do to that gross margin? You know, remember Elon Musk has talked quite recently on a Twitter Spaces on the issue of demand. And, you know, I'm paraphrasing, but his question that he posed was, do you want us to demonstrate unit growth and use price cuts as a way to drive volume growth, or do you want to grow slowly and steady? His conclusion would be that Tesla should grow as fast as they can without putting the company at risk. What I would say when it comes to Tesla's quarterly earnings, Zach Kirkhorn, the CFO, tends to step up, give granularity about what Tesla is doing with regards to the supply chain, the management around the bottom line. Sources have been telling me recently, go back to that last quarter of deliveries. Internally, there's still frustration over the number of vehicles that were in transit, therefore not delivered to customers, and therefore not booked as revenue. So that's still an issue we're going to be monitoring for as well.
Just quickly, some clarity. You touched on it a little bit. Are we going to hear from Elon later?
I believe we will. You know, the context here, Jonathan, is that Elon Musk has told investors in the past that he doesn't believe he needs to attend earnings calls and that there are better uses of his time. But following those statements made 18 months ago, he has continued to attend the earnings calls. He has been in San Francisco courthouse, of course, this week around the 2018 Take Tesla Private tweet hearing, which is a jury trial. And he then flew to Nevada 24 hours ago for the announcement of a $3.6 billion expansion of their facilities there. So there's nothing that tells us he won't be on the call, I don't believe.
Looking forward to your coverage a little bit later. Ed, on the West Coast, on top of Tesla. Oppenheimer's Colin Rusch looking ahead to Tesla results and saying the following. The core issue is whether the company can continue to grow while maintaining premium margins. We anticipate mixed trading on shares as EV competition begins to play out and expect updated margins to be modestly better than feared. I'm pleased to say that Colin joins us right now. Colin, let's start there. The price cuts, and thank you for being with us, by the way. The price cuts of the last couple of weeks, are they a bigger problem for Tesla or their competition?
I really think this is a proactive move on Tesla's part to make it very difficult for their competition to ramp. You know, they have a structural cost advantage because they've designed cost out of the vehicles, and they've got a volume advantage. We think they're pressing that advantage now to make it pretty painful for competition. And I think the real question for investors right now is what's the normalized margin going forward through 2023? I think the strategy that they're looking at is coherent, and there's a lot of investor concern around competition here. But what the normalized margin and cash flow looks like for this company, you know, through 23 and 24 as we go through this adjustment period of actually having competition for the first time is really the heart of the matter for the stock.
Hey, Colin, what do you think it is?
You know, I think it's going to be a little bit better than feared. We think there's some folks betting on, you know, margins being in the low 20s for 2023. I think with the commodity tailwinds, some of the supply chain things that you were just talking about on the program with components becoming more available, plus some of the, you know, the sell-through and utilization on the new factories, you know, point to margins being a little bit better than feared. And I'm not sure we're going to get to the street's at 26.5% right now. I'm not sure we're going to get all the way there from a gross margin perspective. But if we're in the 24-25% range, I think the stock rallies from here.
Colin, given what's happened with price, has that changed your view on what you think the growth numbers are going to look like for the time being, going out several years?
You know, I don't know. So there's a lot going on here. I mean, obviously, Elon's brand has taken a big hit with the Twitter acquisition and some of the behavior around that. You know, we downgraded in December around, you know, just the rounding error or the incremental customer being a little bit more cautious around buying a Tesla just from a brand perspective, and that can start to shave some of the pricing power that the company has. And so, as we look at this, there's certainly demand for EVs. We think there's a very big market. There's an awful lot of consumer interest. The the total cost of ownership advantages, both in the U.S. and Europe, are still pretty meaningful. And so we think there's sell-through at the right price, but I think people are being a little bit more cautious with the, potential recession. We've got a lot of layoffs and, really, pretty decent jobs where folks could be looking at a premium vehicle purchase. And so I think this year is an adjustment year. We're going to find out kind of where the levels are as we get into the first half of the year and what this looks like. The other thing to consider is really the China demand. We've gone through a change in the subsidy regime in China. That adjustment is starting to be felt from an inventory perspective. There's also a little bit of a slow start to the year with the Lunar New Year being early and some of the reopening. And so there's some inventory flush that needs to happen on vehicles and batteries in China in the first quarter here. And as we get into the latter part of February and into March, we'll get a better feel for how the year is going to progress in China. And that will matter for Tesla from a unit perspective.
There's also, Colin, the valuation issue as well. Rates have gone to 450 at the Federal Reserve. That makes a monster difference for companies like this. And Colin, I'm just wondering from your perspective, how one should value this company. I know what the bulls think. It's a tech firm. I know what the bears think. It's just another auto company. What do you think?
Yeah, we've been firmly in the tech company camp for a very long time. We think that these guys are cycling technology well in advance of peers. They're innovating on the material side, both at the battery level as well as the vehicle level, structurally on the cars as well as in the powertrain. But additionally, around the perception and the navigation system, we think they've got real significant advantages around miles driven and learning cycles on that. And so we think you deserve a premium multiple here. What we're concerned about is the adjustment of the auto industry and Tesla's place in it and potential distraction for management. What you were talking about, Elon being on the call tonight, we would expect him to be here. I think he needs to show that he's attending to what's going on at Tesla and isn't distracted by a number of other things that he has going on his personal plate. And so I think he'll attend and be very full-throated about the positioning that Tesla's at and how they're approaching the market strategically. And so we think that ultimately there is going to be a premium as we look at where rates end up and what multiples really are appropriate given the interest rate environment. We'll come back to that. Right now we don't have a price target given our perform rating, but we think there is a premium multiple and a tech multiple that is appropriate for this company as we get a better sense of what the earnings power really looks like.